Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to look at China and just the overall mobility data and really kind of understanding where is China going and how have the floods really impacted them. And then we're going to wrap up with the new OSPs, or the official selling price, coming out of Saudi Arabia, and just giving a broader overview of OPEC. So just getting right into some of the data that we're going to talk about. Here you can see these are some charts that we like to use. They come from Bloomberg. They're assembled. I think they're really good in terms of seeing some mobility movements and just overall general activity. And the two pieces that we're really going to kind of pull out and drill down on is China here. So you can see China's really came off pretty abruptly. And the reason why is they continue to experience a significant amount of flooding. Now they have a typhoon coming up the East Coast as they continue to see flooding on the Yangtze River, as we talked about in our Three Gorge Dam update. And these are key impacts to what is actually happening on the ground and how things are flowing. And then later on we're gonna go through a bit more in terms of their imports and what is happening with their imports, exports, and just general trade coming from China, because that's really going to continue to weigh on not only their daily activity, but also what's going to be their GDP growth going forward. And here, the emerging markets, it's something that we covered pretty aggressively in the economy show, but it's worth noting that you're starting to see this kind of roll over. And we're using Turkey as a pretty good kind of bellwether as to what is happening in some of these countries, what's happening in some of these markets. And you're starting to see some of the pressure come into their currencies. You're starting to see some inflation pick up. Brazil just cut rates. And these are things to start to look at to see, okay, well, what is inflation doing? What is trade doing? And what is going to be the underlying impact to their ability to try to stimulate the economy? The one thing that we continue to see is that the advanced economies kind of hang between this 75, 80% activity level, which is going to be kind of continuous going forward. Now, some of the things that are being done, so excluding China, emerging market activity at the beginning of August remained about 35% below pre-virus level, and that's going to continue to lag, and that's going to continue to remain below. It remains below advanced economies, and we just see that kind of dipping a little bit lower, especially as we have some renewed lockdowns in India and flooding in India, as we've seen in Mumbai with some of these additional typhoons coming through. And then the other component that we need to really kind of look at as we go into the next chart on China imports and exports is the Chinese stimulus that's being done. So the SPB, or the special purpose bond, has been used to try to push capital down into projects at the provincial level. And the central banks have increased the quota when we're talking year over year. So last year, the amount of SPB was about 2.15 trillion renminbi, and now they've actually increased it to about 3.75 trillion. And just to be clear, all of that money has now been spoken for. So we can assume that as we sit in August 7th, and you see additional pressure as we go into the shoulder season and the fall and the cold and flu season, that they're going to have to see an additional increase. And the problem is there's just no projects to give that money to. You're starting to see this seizing up because you can only build so many ghost cities, bridges to nowhere, roads for nothing, until you really start to whittle down and drain your tax revenue because they're not sustaining themselves. And that's why it's important to understand what's happening with China imports, exports. So you had a decent increase in exports. They claim that it was up about 7.2%. Based on what we've seen with boat activity, it's something. It's positive. But it's not. We don't think it's at 7.2. But again, it could be just timing. How are they classifying it? Where are the customs? The bigger impact that we always like to look at is imports, because imports can really speak to what is happening with the local level, because typically they have been importing more from abroad, as you can see during 2017, 2018, when they had a relatively strong economy, as the stimulus that was given out in 2016 really kind of worked through the general Chinese economy. And now you're starting to see that slow back down, which again is going to be a huge weight when you consider, well, what is the Chinese consumer doing? Because the consumer on a global level remains a big hindrance to really kind of getting back to those pre-COVID levels. And it's, China's no different. The exports are kind of like in that kind of that really stable. There's not much there to say, oh, well, the exports are really going to make up for it. It's like, no, things are kind of just here. And we've been kind of working within this normal level. Now, just to give you an idea of what the beat was, so China exports, the expectation was for only an increase of year over year of about 0.6%, and it came in at 7.2%. So clearly, that is a nice little pop. But given where things are, it's something where it could be just timing related, though we do have something closer to 3 to 5% increase. But again, 2%, it could just be timing in terms of customs. The bigger piece are the imports. So the estimate was for an increase of 0.9%. So a decline of 1.4% year over year is starting to kind of hinder in terms of where things are going. And if you consider 2019 is not really a huge hurdle. So to see that year over year decline is problematic. And as we've talked about in our May 29th show, in our Chinese update show, we continue to talk about how the US-China trade war is not ending. It didn't end on January 15th. And this is just some more data points kind of proving that, where China's exports to the US fell 4.1% year over year. So now if we look at January to July, it's only at 1.56 trillion yuan, which is, again, well below where they're supposed to be. And then if we look at imports from the US, which, remember, we were supposed to kind of normalize some of our imports. They were supposed to increase US imports. US imports fell 0.3% to 475.5 billion yuan. So you're starting to see this general slowdown. And just looking at it in aggregate, China customs data is showing that the China-US trade fell 3.3% year over year, which equates to about 2.03 trillion yuan, which, again, it accounts for 11.8% of total Chinese trade. So you can see the decline is going to continue to hurt not just the US in terms of, well, what does our recovery look like, but also China. And that's why it's important to appreciate, we are going to miss these levels. It's really unlikely to see some of this growth, especially as we get, headwinds in not only just advanced economies, but also the emerging market level. And when we look at the emerging markets, these are the pieces where you look at China, and China is now fallen down and is starting to come closer down. And again, this is really going to be driven based on these floodwaters. And you can see how they really did help drive through April, May, June. And now, as other countries start to kind of reopen, you start to see some normalization. China's starting to roll back over a bit. And then the big ones to look at is really China and India, just based on size of the economies, how they were growing. This is really indicative of where those weights are going to be. And we expect India to start also rolling back over as some of these flood impacts continue to hinder their movements and their total mobility. And that's where we look at, on a 7-day moving average, what are we seeing? What is the normalcy that we're on a global level? If we aggregate all the data, it's really, we're sitting between this 80 to 85% number. And it's hard to see any real way to kind of shake off and get back to 100%, just given lack of tourism, lack of consumer, lack of corporate investment. We can see this in jet fuel and diesel, in general driving data, and it's going to be really hard to kind of close that gap. And when we look at TomTom, this is, again, where we start to put all of this together and say, okay, well, what's really happening? Who's moving what? You can see the breakdown, where even though we're seeing some additional congestion, which is just showing people getting back to normal, you're still having problems across the board, and specifically in Shanghai, which it comes back down to what does that normalization look like within China. Madrid, Tokyo are seeing additional slowdowns as you have some COVID resurgence. The other one's that's going to be interesting is Mumbai and Rome. So Mumbai has had their flooding. They've had some issues there, so that should pare back. But Rome is interesting because Italy just posted one of their biggest increases in COVID cases since I believe it was May. And it's the question is this just a blip? Is it something, some of those growing pains as we start to come out and start to try to normalize the most? And these are things that we have to keep looking at as we consider what's going to happen to gasoline demand, what's going to happen to diesel demand. And then that bleeds down to, well, what is going to happen for total oil demand, which leads us into our topic about what is happening in OPEC and how are those pricing movements going to continue or hinder flows of oil into a lot of these markets. One of the key data points that we were waiting for was to see what Saudi Arabia was going to do in terms of their OSP, or official selling price. So the official selling price going into Asia was expected to be down about 43 cents or so. And if you can see here, it was only down about 30 cents, depending on which blend we're talking about. Into the Mediterranean, into Europe, it was down a bit more, and then flat into the US. And the problem is, I would have expected to see a bigger drop going into Asia, just because there is less demand. They want to try to incentivize people within these specific countries to try to pick up more and try to keep some of that flow going. The Mediterranean, they're starting to compete a bit more against the euro. But the one thing that we have seen are euro prices, which are coming out of Russia, have been trading at a steeper and steeper discount, and they're back to about 3 to 4 month lows. So it makes sense to see some of these cuts coming in, and then into the US, just given how much storage we currently have, you're seeing that they're expecting little or not too much new demand going into the US as we go through September. And if you consider where we're sitting with about 79% utilization rates as we head into the shoulder season, it's going to be difficult to see a huge increase in imports into the US. So the bigger focus for them is how do they get into Asia and the Med, and you're starting to see them compete a bit more into Europe, but Asia remains a little light, which will be interesting to see how is the additional flow going to be adopted. And when we look at OPEC and we go through July estimates versus June, you can see that we had about a total increase of about 900,000 barrels month over month. And it was really driven by Saudi, which had the biggest increase of 920,000, which should be expected given, they're coming out of, they did an additional 1 million barrel a day cut. It was 1.2 million across both the GCC, all of the GCC countries. So you're starting to see some of that normalize a bit, and we should see another creep higher as we go from July into August and then August into September, which again, if you look at pricing, and now you're getting additional flow. So some of the additional flow will stay in country for the need of new electricity generation, because this is the time when you have an increase due to air conditioning. Iraq just set a record in some of their locations with the hottest day ever. So you're starting to see some of that local burn, which will take some of this oil out of the export market, even though they're producing a bit more. But it still is increasing, and they're going to have to find places to put it, which will be problematic given some of the backdrops we're going to lay out. One of the biggest backdrops is Iraq. So when you look at Iraq production for July, again, they missed their estimates. They missed their target. So the target here, you can see from May, June, July was supposed to be that red line. The red line was supposed to be about 3.59 million barrels a day. And instead, they produced something closer to about 3.8. So June and July was problematic because you were supposed to be at 3.6. You came in at 3.8, but then in June, you promised in July you were going to have an additional 70,000 barrel a day cut, which is that green line. So you missed by even more in July. Now they're coming out and saying they're super serious. They're super serious this time. So in August, they're going to have an additional 400,000 barrel a day cut, which is that tan line, which means that they're going to go from 3.8 down to 3.4. And then in September, they're going to increase a little bit and only have a cut of about 313,000 barrels a day in September. So you can see how you're sitting here and saying, okay, well, you've been cheating. You cheated again, but we're going to you promise not to cheat going forward. Even though your GDP is struggling, this provides cash flow. pricing is relatively strong for where it should be, and you're not going to continue to cut. You're not going to continue to cheat. This is where we start to see a struggle with what is actually going to happen going forward. So then when we step out and look at OPEC seaborne exports, so exports out of OPEC increased 567,000 barrels a day through July, according to Kepler. So we had an increase in production of 920,000, which led to an increase of exports of 567,000. So you're starting to see how, even though you're getting some of the additional production used and consumed internally, you're still seeing an increase in exports month over month, with Iraq actually seeing an increase in exports by about 50,000 barrels between June and July. Again, these are key things that are going to be problematic. And when you think of, well, who's driving the increase in exports? The UAE led export gains by increasing 414,000 barrels. Saudi increased 169,000 barrels, and Kuwait 163,000. Again, the GCC, or the Gulf Cooperation Council countries that had the additional cuts of 1.2, brought them back, and most of that, or a large part of that, did hit the open water and is going to continue to weigh on pricing as the volumes increase abroad. And that's where, just to kind of look at that a little differently, to look at export volumes, here you can see the Gulf export increases. And these are the numbers that we were talking about. And you can see a lot of that was driven based on the UAE. And again, Iraq had that little increase. So you're looking at these key countries, and this is one of the big reasons why we're seeing some of this pressure in the market that we've been talking about for a couple of weeks, because we started to see this softness as you saw discounts increase on spot cargoes. Nigeria is still struggling to sell, which we'll talk about in a minute, but Angola, again, is kind of going to be our bellwether for what is happening in China. Then we look at Saudi starts, and this is the extra June supply being reversed. So this is the 960,000 that we're talking about, but we have to consider, where is this crude going? And, right now, India diesel sales were down in July 13%. Gasoline was down, So India gasoline sales were down 13% June into July, down 21% year over year. Gasoline was down 1%, down 12% year over year. And jet fuel was again down 65% year over year. Now, the year over year numbers are so important because it picks up that seasonality. So we want to look at it from apples to apples. So we continue to see the diesel side of the equation remain a huge bellwether for production within India, which is continuing to weigh and show the economy is just not recovering the same way, which is going to impact the way they're importing crude, as we see flooding continue to weigh, not only on China, but also on India, which is going to be something to consider as we go into August and September. And this is really appearing in that Asian floating storage. So we saw, floating storage start to come down pretty aggressively as we saw the ramp up, and now you're starting to see it flatten out. So I was talking to Fernando Valle at Bloomberg, and we had a really interesting conversation, because I was saying, look, things were terrible when we're looking at realizations. We're seeing additional pressure again today on crack spreads, and his comment was, well, this was the same thing in April and May, which is 100% accurate. It was the same thing. And then as we kept going through, we decided, well, what was happening? What was so different then than right now? And it was China. And here you can see in April, May, when crack spreads were getting hurt, China was buying, Asia was buying. That's when we saw this huge explosion to the upside of floating storage. You saw the big increase as they were going out and taking advantage of this great pricing. And now we're getting the same pressure on crack spreads, on realized prices, on spot cargoes. You don't have your savior. China's not going to sit there and continue to buy as they're so congested, which is you're really seeing in this floating storage chart, where they're starting to replace some of the barrels. They're going to start picking apart and getting specific. And this is really where you're seeing those pressures, which is why we continue to be bearish total pricing as these things weigh on the total market. And as you can, and just giving some data points on that, China skipped buying some Kazakhstan CPC blends. You have Asian refiners didn't pick up any Euro cargoes for July loadings, depending on where we're talking about, and that's the first time since January of last year. So we're starting to see guys get more specific in terms of what are they willing to spend, what kind of blends are they willing to pick up, and this is going to weigh on total cargoes. And then just to look at that in a different manner, this is the amount of supertankers heading to China. You see, there's a huge drop off, and again, that April to May, where even though we saw some significant pricing pressure, you still had China, which was essentially going out there and sweeping the market and putting it into storage. Now, this is the huge drop off, and it's really reflecting in day rates, where we have the benchmark supertanker rates hit a new low in 2020, fresh lows in 2020, and then you have a decline in U.S. Gulf rates. But the interesting thing is, which is the one that we always like to look at, is the clean tanker rates, which are continuing to creep higher, which means that there is a bit more movement on the refined product level as oil shipments don't really move. And then that takes us into that Middle East floating storage, because we have seen an increase in production. We're not seeing the same type of movements as we would have expected, which is really starting to show up in the floating storage levels. And this is why we kind of break it out, because 2016 is so high. We want to look at it. Where is it in relation to everything else? And you can kind of see we're right within the upper end of that average, which we think is going to continue to creep higher, because there's going to be about 25% more vessels available for floating cargoes over the next 30 days, as China and Asia in general are taking less cargoes. So we should see this pick up, especially as we have tanker rates coming down. So now it's a little bit cheaper to put it on the water and to store it. So this is where we're starting to see this contango start to pick up, which we think is going to continue to weigh on pricing as we go through the remainder of August and well through September. And again, West Africa is seeing something very similar. Nigeria has been very slow to be able to sell cargoes. We still remain at the upper end of the 5-year average. Angola is starting to see a little bit more of a pickup, and this could be because they've given some of the steepest pricing discounts, which again is going to help move some of the crude. But we're not seeing the same type of adoption coming out of the Middle East, coming out of Russia, and coming out of Nigeria. So these are key things. And the Angola, Senegal made their second price cut to give you an idea of what they're doing to try to incentivize and get some of this crude off into the remainder of the market. And this is why we remain relatively bearish. The crude market, or as we look at pricing, the slate as we go forward. And again, the crack spreads are just not going to help increase or incentivize running more oil, just because there's just no real price incentive and the margins just aren't there. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.